We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Matthew Piepenburg, Commercial Director of Matterhorn Asset Management and the author of Rig to Fail. Thanks for joining me today, Matt.
I look forward to it, Tom. Thanks for having me.
So you recently wrote an article entitled Nothing is Real. And in it, you wrote that if you had told any of your professors that one day we would see simultaneously the treasury yield at 1.35%, CPI at 5.4%, all-time highs in the S&P, and all of this despite negative GDP rates and consumer sentiment tanking, that they would have told you to return your diplomas. So how has our reality become so far distorted versus what was taught to you in school?
Yeah, it's a great question, Tom. I mean, truthfully, in school, we learned about markets reflecting true economic indicators and, asset classes or risk asset classes in particular, our growth, being reflected in the markets. But we have negative GDP growth. We have the Fed, the Atlanta Fed, already cutting its GDP forecasts in half. We've just got horrific fundamentals in the Main Street economy, and yet the stock market and the risk asset markets, the stocks and bonds are hitting all-time highs, and we've got 19 trillion in negative yielding sovereign bonds around the world. The difference between when I was in school and when I became a part of this Wall Street circus, in a sense, in the last 20 plus years, is what we have today, which we didn't have when I was in school, in particular since 2008, but I would argue since Greenspan came into the Fed. I think he's the patient zero of the bubble story, the bubble narrative, for so many ironic reasons. What we really have today, it's nothing new to a lot of people, is a completely engineered risk asset market. When you take the great financial crisis as maybe one starting point, although I would go back to 87 with Greenspan, but when you look at the balance sheet of the central bank going from 800 billion to over 8 trillion since before the great financial crisis today, you just see massive amounts of liquidity at the same time that you're repressing artificially the interest rates. So you get the low cost of debt and you get massive amounts, trillions of dollars in liquidity through QE 1 through 4 Operation Twist and now unlimited QE. That was something, frankly, in the late 90s when I was in school, we didn't even discuss that kind of phenomenon. It would have seemed unthinkable. In fact, the central bank wasn't even a topic. Most people in the late 90s, or certainly when I was in school in the early 90s, didn't even know what the central bank did, didn't even know what a Fed chairman was. Now the Fed in particular, and the Fed chair, himself or herself when Alan was in office, has really become the indicator for risk assets. What will the Fed do? What will the Fed meeting notes say? How do you translate or sift through the jargon to find a common denominating, positive, dovish, hawkish message? And the sad fact is the Fed has become the market. It sounds like an exaggeration, but fundamentals matter less and less. Fundamentals like growth rates, fundamentals like GDP, fundamentals like productivity, fundamentals like free cash flow or dividend yields or strong balance sheets or financial statements, all the things that were sacred would not explain the stock market, the Dow or the S&P or the NASDAQ today in any form or fashion. And it's kind of sadly become ossified into a new normal, an expected new normal. I think, what was it, just in the last, since February, it was 4.5 trillion in treasury bonds issued. And the Federal Reserve bought 56% of those. I mean, in a way, it's extraordinary when you think about it. That would be like me writing a book, claiming I'm a bestseller, but not telling anyone that my uncle in Texas bought every copy of the book and stored them in his garage. It really doesn't make me a bestseller, although on the surface, technically, I've sold enough books. And in a sense, we have a market that's just as bogus as me being a best-selling author with my rich uncle. The rich uncle in this case is Uncle Fed. And he's greatly benefited the spoiled nephews and nieces on Wall Street since 2008 in particular. But again, I'd argue since Greenspan, the new Fed sheriff in town, came in 87 and effectively wasn't Volcker 2.0. It was the exact opposite. When you talk about giving a punch bowl to the markets, since Greenspan, it's been a keg party extraordinaire. It's just, there's simply no way, bull or bear, you can deny that the markets are correlated to central bank policy. And central bank policy is instant liquidity at the drop of a hat whenever the market takes a dip, and artificial repression of interest rates by buying bonds to keep yields down so that rates are low. And that's caused what they call a recovery or accommodation or a solution, which is really masquerading as a poison, in my opinion, because that is completely distorted free price discovery. And anything that we learned about capitalism in school is pretty much forgotten now.
Yeah, it reminds me of a conversation that I had earlier this week where, thinking about the outcomes of all of this cheap money, free money has really, in a way, destroyed the notional, let's say, definition of what was value, right? How to value a company. All of those metrics are basically out the window, right?
They're effectively gone. I mean, there is always been a strong difference between momentum investors and value investors. It's very hard to be a value investor today in just about any asset class, from real estate to bonds to stocks. And there's a natural inclination to track both kind of markets, but we've become a momentum market, and the momentum is fed by a tailwind. It comes from the central bank on Constitution Ave, the Eccles building, which ironically is even, in my opinion, a constitutional body. It's technically a private bank, but it's becoming more and more essential. It's effectively financing the United States, and it's certainly financing our risk asset markets. And so that is not what Thomas Jefferson, Andrew Jackson, or even Woodrow Wilson, who wrote the Fed into law, would have wanted to see happen. Frankly, if Thomas Jefferson were alive today, he wouldn't even call this America. But that is a sad truth, and value is completely distorted. David Stockman wrote a fantastic book years ago called The Great Distortion. And he went through cycles of hot money and debt and low interest rates. And, that happened in the 1920s, of course. But what we're seeing today since 2008, it defies all precedent in terms of extreme exaggeration.
So what other tricks can the Fed use to still dump, as you put it, ever more dovish liquidity into the system? Even if their official stance was a move towards tapering, if they actually ended up, supposedly taking that stance, how can they still get around that?
Yeah, it's interesting. A lot of retail investors and frankly, a lot of retail advisors don't want to get into the morass and complexity of the standing reverse or the reverse repo market or the standing repo purchasing facility. I mean, in a sense, the Fed can talk about tapering all day long, and it's making a lot of headlines. It's got people nervous and hanging on the edge of their seats at every FOMC meeting to see what Powell's going to indicate or hint. And the headlines are fascinated by this taper debate, because obviously if the Fed were to stop buying bonds or to taper or slow that down, typically yields would go up. When the cost of debt goes up, interest rates goes up. When that happens, risk assets and stocks and bonds tank, right? And that's a big fear. But really, I think what's not being spoken, and very deliberately so, is, the Fed has other liquidity tricks up its sleeves. The taper is almost kind of a smokescreen, like a magic trick. Just focus on my left hand and ignore what I'm doing with my right hand. And even if there were a taper, with the SRP, the standing repo facility, the Fed can still dump hundreds of billions per month or per quarter into the risk asset market, particularly the bond market. It's complex, but it basically boils down to another form of liquidity under a different name. The SRF is just QE by another name. So taper or no taper, I don't think the Fed is going to allow the US bond market to tank, for the simple reason, if treasuries tanked and yields spiked, interest rates would have to go up. And that's simply impossible now when you have $28.5 trillion in public or federal debt right now, or government debt. And then you tap onto that, the zombification of the corporate debt world in the US and everything that's on the S&P that is just living on a continual debt rollover. If we had a federal funds rate of 4 or 5% in a normalized way, we literally could not sustain our debt at that level. It's simply not possible. So this fiction, this drama about will they taper or not, they don't have a choice. They cannot let interest rates or yields spike above 4 or 5% because they wouldn't be able to sustain their own debt. And, I think Stanley Fischer talked about this in 2019, when debt to GDP gets to a certain ratio, we have to get nervous. Can we sustain this debt? That was in 2019. But, interestingly, we've crossed the 100% debt to GDP Rubicon. And whether you're von Mises or you're David Hume in the 18th century, every mathematician knows that once you cross 100% debt to GDP, you can't grow your way out of that debt. You lose productivity by 30%. And what's fascinating, you see the fork-tongued, incredibly magical ability of central bankers, including Powell, to deny this. He came out earlier this year in an article in the Wall Street Journal where he admitted that the debt was unsustainable. But he said not to worry, that we'll grow our way out of this. And I talk about school and diplomas. I know Powell must have gone to grad school. He has to know that's just untrue. When your debt to GDP crosses 100%, in this case, 120, 130%, you're not going to grow your way out. So his answer to our debt problem was, we're going to grow our way out of it. And that's simply not true. And it's simply impossible. COVID became a great pretext to blame this, slow growth on COVID. But the truth was, well before COVID became official in 2019, early 2020, but by late 2019, it was already clear that we were unable to handle our debt problem then. And COVID allowed a great deal of fiscal and monetary stimulus, more money printed in a year than we saw through 2009 through 2015. So COVID was, and I said this ironically, was the best thing that ever happened to Wall Street, and that's sad. And there's a whole other conversation about that, whether that was deliberate or whatever. That's crazy, but it was very convenient to have this COVID crisis when we did.
So, Matt, isn't there an argument to be made that, considering that we can just print or borrow as many dollars as we want, doesn't the debt not matter? Can't we service it no matter what?
Well, absolutely you can. I mean, technically, if you use modern monetary theory or this new magical solution, this magical moneymaker at the Eccles building where you can mouse click a zero whenever you want and add to the balance sheet, you can print as much money as you want to service as much debt as you want. And sadly, that was once considered extraordinarily stupid idea 5 or 10 years ago. Now it's become mainstream. It's become political. It's become almost accepted. But everyone listening to this, whether they understand central bank monetary policy or fiscal policy, if it sounds too good to be true, it's probably because it is. If you can print money, you can sustain your debt. You can pay your debt. If any of us had a money printer in our basement and we could pay our mortgages, our tuition, our kids' education, the new car we always wanted, just by going downstairs and printing it, we would do it. It's seductive, it's tempting. But if a government does that to the level we're doing in the US or in Japan or in Europe or in other countries, if you do that, you get to pay your debt. But what you do simultaneously is you absolutely destroy the value of your currency, which is the evidence of that is everywhere. And of course, you create inflation. And we can talk about inflation too. But yes, technically the answer is yes, you can print infinite amounts of money, unlimited QE, to always sustain your debt or to service your debt, but you do that at the expense of your currency. And ultimately that hurts the middle class more than the top 10% or 1%. Inflation is a painful tax on the poor. And, I live in the south of France and I'm surrounded by rural farmers. And I literally had someone come to my house yesterday, my neighbor I've known for 20 years, asked me if he could look in my barn for some plastic tarp for his hay, because the price of plastic has gone up 40% here. He can't afford a plastic tarp. And I think that, me being this Wall Street American living in the south of France with these good friends who I watch struggle every day, it's not an intellectual debate anymore for me to see the real pain of inflation on regular people. And it bothers me. And of course, it bothers them even more. But to answer your question, yeah, you can print and you can pay your debt, but you're diluting your currency and you're creating inflation. However, it's measured on the bogus CPI scale. On the grassroots level, you see it really hurts people. And to me, it's disturbing. It really is.
So you mentioned the debt to GDP ratio, and we've heard before that the getting above, let's say 130% is a significant number for many defaults in history. So considering that the US is now at 135%, is this a matter of time before we default, or is it different because the US is the reserve currency of the world?
Well, it's important because that is an important distinction. We aren't El Salvador. We aren't Mexico. We aren't Yugoslavia. We are the world reserve currency, and we've been able to export our inflation to the rest of the world for decades. It's really, frankly, quite immoral how we've been able, as the world reserve currency holder, which is a fiat currency, by the way, not even gold backed since 71, been able to live well above our means and break the odds and break the historical traditions. I use the example of France in the 1780s, early 1790s. They had a very similar QE1 through QE4 Operation Twist money printer good time rollout. And they weren't the world reserve currency. And once their debt to GDP went way beyond 100%, they ultimately blew apart. And what followed was an authoritarian regime. That's what opened the door to Napoleon. We can talk about that. Centralized control always follows a debt extravagance. When a country has its back against a debt wall, it inflates its way out of debt, it crushes the middle class, and then it blames it on somebody else. And then ultimately the system fails and someone like a Napoleon, Mussolini, Franco, or worse comes into power, and you lose more and more of your civil liberties and your rights. In the case of the US, does 135% GDP mean nothing anymore because we're the world reserve currency? Jeffrey Gundlach the other day at Double Line was saying we're acting as if we don't care about being the world reserve currency, because what we're doing is we're making a mockery of it. And that's why I think the answer to your question, the short answer is no. Even the U.S. with the world reserve currency can't get away with this forever. for me to try and tell you it'll be over by 2022 or 2023 is a mug's game. No one can say how or when exactly it'll play out. It's already playing out badly in so many ways all around us, but I think it will end badly I don't think the US will lose its reserve currency status this year or next year, but I think the IMF and others have already signaled a new Bretton Woods or a new reset in the future. But again, blamed entirely on COVID, despite the fact that well before COVID, we were way over our skis in debt and the things were falling apart already. Again, COVID is a brilliant pretext and excuse with a wonderful kind of humanitarian guise to justify more and more of the same absurdity. But I think they're going to use COVID as a pretext to have another Bretton Woods 2, probably have a central bank digital currency, restructure the debt in some kind of glorified bankruptcy restructuring for the major developed economies. And again, rather than blame the central bankers or the policymakers, blame it on a pandemic with a 0.5% fatality rate. So things are very strange, but I don't think it'll be long before we see some type of gala event like a Malta conference, but it'll be this time a new Bretton Woods where we're going to have to restructure currencies, rethink SDRs, rethink the US dollar. But for now, I wouldn't see the US losing that currency anytime in the next 6 to 12 months. But the writing's on the wall that there's going to be some type of major shift. Again, blamed on a pandemic, not blamed on the folks that put us here, but it'll still be a solution based on a digital currency. It won't be Bitcoin or Ethereum. It won't be gold backed. It'll be a central bank digital currency, probably not, it probably won't be part of the M2 money supply official statistics, but it'll just be, as we were joking earlier, the same music by a different band, ultimately toxic and fiat, and ultimately based on more controls, capital controls.
So I'd like to kind of go back to the mechanics of how this stuff works, Matt. Something we've touched on many times on the show is the Basel III requirements, but really pertaining to gold. But how do the standard repo facility and the reverse repo program allow banks to circumvent these rules?
Well, it's interesting. I mean, Basel III and the reverse repo are distinct, and yet they're kind of linked. We'll start with Basel III, I think, because I think it's really interesting what happened recently. One thing in particular which pertains to the gold price. I mean, you can go back to 1971 when Burns was in the Fed and Nixon was in the White House and Kissinger was floating in between both. There's a great book called 3 Days at Camp David about that, the pressure politicians put on the Fed to bail them out of a fiat currency scenario that was going badly after we decoupled from gold. But from the 1970s on, and certainly into the 1980s when we started getting into futures contracts and forward contracts at the Merc, and we took this sleepy exchange, which was supposed to be for farmers in Illinois and Michigan to set the price of corn so they wouldn't get beaten up if there was a bad weather event. You had guys like Malamed and, frankly, a young Martin Friedman and a young Alan Greenspan in the 80s creating forward contracts and futures contracts on all kinds of assets on the Merc. And that led to massive amounts of leverage in the gold market after 71, when we decoupled from gold and the inflation started to hit in. The biggest thing that the central bank and the White House was afraid of was gold rising in price on natural supply and demand, going back to these natural forces that you said I would have lost my diploma for. Gold would have ripped to the moon in the 70s. And that was their biggest fear. That would prove that the experiment of decoupling and having a dollar backed by this, the good faith of the US Treasury wasn't really believable. So in the futures and forward markets and the over-the-counter markets, they were able to have massive amounts of levered contracts doing a permanent short on gold, using leverage and using deep pockets at bullion banks or LBMA banks. It is a long and complicated story, but it basically boils down to there was always a boot to the neck of the natural gold price. But when you have hundreds and hundreds of thousands of contracts going long, but only 8 banks going short gold, but those 8 banks going short gold had so much money they could keep the price contained. That was not natural price discovery. But why were they picking on gold as opposed to, say, aluminum or copper? Because gold is a store of value that, just like Bitcoin is a threat to the dollar, gold was a major threat to the dollar. And so there was a need, and Volcker was always asking about the price of gold, just like Burns was. What's the price of gold? That was their big concern. And Greenspan, who used to be pro-gold, but now is politically correct, doesn't talk about it as much, but admits that it's rising. Why so much fear of gold? Because gold was the proof that the experiment post-1971 was a failure. And, look, Measured in a milligram of gold, the dollar has lost 98% of its value since 1971. Again, people think that's a gold bug statistic or clever math. It's just an objective fact. And so the dollar can have relative strong purchasing power against other currencies, but its inherent purchasing power, like other major currencies that are fiat currencies, measured against gold has just been slammed. And frankly, gold would be well past 2,000, 4,000, 5,000 a day if those markets didn't allow so much leverage. What Basel III did, to get to your question, what Basel III did is say, well, there's too much leverage on these banks, these bullion banks, these other large, too big to fail banks. They actually have too much leverage, so we're going to require them to have what they called allocated or good assets, more allocated good assets on their balance sheets before they could use these forward or future contracts. In other words, they had to have more gold. They had to have more physical gold, and that was supposed to curtail some of the leverage, and that was supposed to give better free market price discovery to gold. And as we said at the time, that wouldn't change much because the truth is only the big banks can actually take delivery of that gold. If anything, all Basel III did was make a facade of cleaning up the good asset side of the balance sheet of these banks to have their net stable funding facilities more kosher. But really all they did was just make that market even tighter, because most retail investors can't actually take delivery of a contract on the futures market. So it tightened the market, gave those banks larger control. And the truth is, most of those LBMA banks didn't even have enough gold to meet the Basel III requirements that they said they had in their balance sheet. So we had a flash crash a few months, not long ago in gold, which we wrote and talked about. And all that was as nothing new under the sun. Big banks were pushing the price down to buy more gold to get more gold on their balance sheet to comply with Basel III. But as we've watched, and again, this kind of ties into the reverse repo markets and other things, the Fed has already signaled that if there is a problem with treasuries, or if there is a default, or if the debt ceiling doesn't happen, I mean, when the Fed will step in and actually buy defaulting treasuries, and they'll actually let banks spend off defaulting treasuries, and they'll reduce the Basel III requirements on these big banks. So the Fed is doing everything it can to keep supporting banks. And the reverse repo market is nothing new. It just, if banks don't trust each other to give each other overnight funding so that they can leverage that, which is what happened in September of 2019 when the repo market crashed and the repo rate spiked to 10% in a day because JP Morgan didn't trust Morgan Stanley or Goldman Sachs, what they did a week before. The Fed came in, became the lender instead of the banks themselves. So again, they're doing everything they can to support banks and to support risk assets and to support leverage and to support liquidity. Their biggest fear is a lack of liquidity. That mandate of the Fed is always Wall Street first. And you could argue that the Fed is in bed with Wall Street. I think Wall Street's in bed with the Fed. It's a mutually assured toxic relationship. But there will always be liquidity for these banks because the meme is that we can't survive without them, and that they're necessary to keep stock markets functioning. Stock markets can function, but a healthy stock market has to have a correction, a significant correction, constructive destruction every 5 to 7 years. The Fed now politically, and White House inhabitants, red or blue, want to outlaw those type of natural constructive destruction cycles because it's bad for politics, it's bad for their business, it's bad for optics. So at the expense of a market falling, they're letting the middle class die and the productivity and the GDP die, but to keep a risk asset bubble going to all times. And when Yellen was a vice chair and when Powell was a Fed governor back in 2011 and 2013, before they were Treasury secretaries or Fed chairmen, in their notes, if you look in their diary, when they were talking about the debt ceilings in 2011 and 2013, they were saying, what if Congress hits an impasse? What if we can't meet our IOUs? What if the Treasury Department defaults or something? Well, the notes said, well, then we'll just buy bad treasuries. We'll just let banks lend up. So they've already thought about the unthinkable. They'll never let that liquidity dry up in the markets. And what that means is it's an artificial engineered market. Now, to stock investors, that's great. It's a stock market that never falls for more than 10 minutes. And then there's always more liquidity. I think the point no one can answer is how long can that go on and how long until people catch on? And I think they catch on when that liquidity becomes so inflationary, again, despite a bogus CPI scale. When that inflation, like my farmer friend who can't afford a plastic, tarp, when that just becomes too obvious and too painful. And the wealth disparity, which we see now is the greatest in all times, really greater than 1790 France, greater than 1917 Russia, greater than the most extravagant periods of the Gatsby era. When inflation becomes so painful, no one wants to hear the excuse that we bailed out the markets because 86% of the stock market is owned by the top 10% of wealth, including me. So I'm not saying this to be an apologist, but it doesn't feel good to be successful, quote unquote, on such a completely egregiously disingenuous system. And I think that as more and more people become aware of that, they don't have to have MBAs or law degrees or work on Wall Street, as they just see there's something wrong when the vast majority of wealth is held in the hands of people who don't even create wealth or don't even create a product. They just spin contracts and extend and pretend. The vast majority of stock buybacks on the stock market have been by CEOs who buy their own shares, and they buy their own shares because their salary is based on their share price. They're not putting that into CapEx. They're not putting that in productive. They're not putting that into bringing jobs into America and producing things at home. So there's been so many just absolutely appalling lack of ethics and sound financial management that have made a massive amount of people massively wealthy, despite an even bigger amount of people increasingly poor. And inflation, I think, the pain of inflation will tip the scales. And when that faith in the Fed and the markets and policymakers and White House residents falls, we're going to have more social unrest, like it or not. And whether it's pitchforks or the January storming of the Capitol, whether it's 1789 France or 2001 Washington, we're seeing a lot of that social fracturing now, sadly. And people don't notice, they point the fingers at QAnon or BLM or whatever new movement of the day. But really, people are just financially frustrated, I think. And I think that type of social unrest always follows a debt crisis. And we are in a debt crisis of all time. Global debt is at 300 trillion. GDP is 1/3 of that. U.S. total combined corporate, government, and household debt is well over 85 trillion. It's simply an unfathomable number. It's not sustainable. But the question when it ends, I don't know. I really don't know. When faith in it ends.
Yeah, absolutely. Faith and confidence in the system is a big piece of that puzzle. And to your point earlier, I remember, I think it was Volcker in the 80s actually stated that they didn't do enough to control the price of gold when inflation was ripping and after we came off the gold-backed dollar, right?
Yeah. Yeah, I mean, they were terrified of gold. Remember, gold makes up 0.5% of world, financial assets. It's a very scarce little commodity. And it shouldn't be so terrifying to these central bankers and policymakers. And yet that small, scarce little barbaric relic, as Buffett calls it, is on the minds of policymakers since the day we decoupled from the gold standard. And by the way, welched on all our currency partners in the world. Nothing new there either. The U.S. has neither permanent friends nor permanent enemies, just permanent interest, self-interest. It's very realpolitik.
So there's another piece of this that I wanted to touch on as well. And that was a couple months ago when the Fed set up foreign repo facilities. So is this just basically another way for the Fed to try to provide liquidity to other central banks? And could one argue that this is actually a good thing in times of stress rather than a negative?
Well, it isn't. I mean, basically it is like a foreign repo market, right? Just like we have the reverse repurchase market here among our big banks in the U.S. who can lend to each other. Now we could have a kind of foreign repo where central banks can lend to each other. I think that's actually the direction it's going. The IMF signaled this last summer, again, under the guise of the new COVID concerns and the new debt concerns and the need to come up with a new way to deal with this debt. And really what that boils down to is I think a new Bretton Woods. Remember after World War II, when the world was on its knees after millions of deaths and the destruction of economies all over Europe, a true world war, unlike the war on COVID, which is completely disproportionate to its viral reality. They're using the war on COVID as almost as if it were the equivalent of World War II. Anyone who's survived World War II who's watching this would know you can't compare the two. Anyone who lives in Europe knows you can't compare the two. It's absolutely insulting to suffering to compare COVID to what happened in World War II here in Europe. I mean, just walk through any cemetery here. It's full of young men younger than me. And so, but nevertheless, they're using what was an astronomical cataclysm in the 20th century, World War II, and when the economies were on their knees and people were just coming out of the rubble and we had to have a new Bretton Woods and have a gold-backed US dollar. Now they're saying we need a new Bretton Woods because of COVID. Now, it's not because of COVID. It's because of 50 years of just extravagant debt, hot money and wealth disparity. What the IMF will do and what they're signaling is a reset basically a large global Chapter 11 blamed on COVID, which will be cooperating among central banks to probably create a central bank digital currency, which again, like every digital currency, is ultimately fiat. It's created with a mouse click. It may be used only within central banks, but they'll provide each other with liquidity and call that a solution. It won't be a solution. It will maybe buy some more time. But again, that's a form of taking central bank control in the US, which we can talk about. There's more and more centralized control over our economy and over our lives, and making it global. And so central banks will be more and more instrumental in economics and in supply and demand, quote unquote, and in global finance. But it's really just, again, the same trick, different pony. It's still just a new form of fiat currency. They can call it a central bank digital currency. It'll be used to give each other liquidity to become what they will say is the saviors of this crisis. The irony is they created the crisis. The bankers, the central bankers, the politicians literally have created this crisis from Nixon on. And frankly, prior to Nixon, I mean, there were only a few good presidents who actually balanced the balance sheet and raised taxes rather than printed money, like Eisenhower and Truman. But sadly, the crop of politicians, left or right, center, purple, red, or green, they're shamelessly ignorant of history, shamelessly ignorant of economics, and shamelessly self-interested. And so to stay in office or to stay popular, they've lived on debt. Now what will happen with the IMF reset, a central bank digital currency, they'll create more liquidity. It will not be backed by anything real. It'll be on new trust. They'll make the vast majority of people think it's a solution, some brilliant solution from our anti-heroes, otherwise known as elite strategists, but it's really no new solution. We're afraid to have the austerity that follows every debt crisis. And whether that, again, is ancient Rome, 18th century France, 21st century Yugoslavia, or the US today, you can't have this many martinis economically without a hangover. And I think they're desperately trying to avoid that hangover. And for now, sadly, a lot of uninformed investors or struggling Americans who have other problems just tend to still trust that meme. They still trust that belief that somehow they know what they're doing. I mean, being inside that world for 20 plus years, I don't have that same faith, but I do believe in the faith of illusion. I think they can keep it going for a little longer. We'll see. Until, again, inflation becomes too painful. And then people either become more and more dependent on a check or a handout or a rent abatement or a mortgage moratorium, and they just become serfs in a new feudalism that's no longer anything even remotely resembling capitalism.
So, Matt, I wanted to kind of stick on the international side of things. How does the issuance of more SDRs or special drawing rights affect the global appetite for gold?
Well, just this year, just recently, the IMF, what was it? It was 650 billion in SDRs that came out this year to add liquidity or give stimulus to the economy. 650 billion almost sounds like nothing compared to what we're used to printing every year. Mm-hmm. Now, I think what that really just means is they're setting the stage for more and more IMF involvement in the world. A lot of those SDRs are, of course, US dollars, but it's just showing the IMF, like local or national central banks from the Bank of Japan, the ECB, or the Fed, the IMF is just doing the same thing, creating instant liquidity. What that will do for gold is very simple. I mean, again, and we can talk about gold in particular, but of course, it's ultimately a tailwind for gold. When you create currencies or you provide liquidity or you mouse click liquidity, whether that's at the Fed or the Bank of Japan or elsewhere, when you create that kind of liquidity, it does devalue the currency. Many will say in the case of the Fed, but it's no different at the IMF, if that liquidity goes between the Fed and the Treasury and the stock market, and you see only inflation and risk assets, then you don't see velocity of money and inflation on Main Street. And that's actually somewhat true. Why, after trillions in money printing, hasn't the dollar just lost all its value and is in inflation past 20%? Part of the reason is that inflation was contained in a risk asset bubble, the likes of which I've never seen. And I started my first hedge fund in the dot-com bubble. I thought that was crazy. Oh, wait, look crazy. This is beyond the pale. But what people don't see, in addition to that monetary stimulus, which ultimately will be inflationary because the central banks are not just, the lenders of last resort. They're now becoming spenders. They're making direct purchases of ETFs and even some individual corporate bonds, which they've supposedly given back. But they're becoming spenders. So that actually affects the velocity. The other technical term is monetary policy may contain itself, but fiscal policy, whether it's this 3.5 trillion new plan that Biden has, whether that passes next week or not, or this week or next week, whether the debt ceiling is crashed, whether it's the PPPL or the PPPL programs or the Care Packages Act, all that fiscal ideas that fiscal stimulus has to be paid for. It's deficit spending. We're at all-time highs in deficit spending. So to pay for that, again, the Fed will have to step in to be the lender, spender of last resort. When that money goes into Main Street, that is inflationary. So the combination of extravagant monetary policy, now when you complement that with unprecedented fiscal stimulus, that creates velocity of money, that creates inflation. Inflation, to get to your question about gold, whether it's international or national, if all these national policies are the same and the IMF, along with the central banks, are doing the same thing in different corners of the world, that's highly inflationary. And so high inflation means typically a tailwind for gold. And negative real rates, that is when inflation is outpacing the yield on sovereign bonds, well, that's an extraordinary tailwind for gold. And frankly, right now, depending on which inflation metric you look at, whether it's the 10-year break-even rate or the Chapwood Index, which uses the 70s measure of inflation, we have negative rates of either 1% or negative 10 or 11%, depending on which scale. Frankly, the Chapwood scale, which is the most accurate, which is how we measured CPI in the 70s when we had inflation, would put us at 12% inflation today. If you've got a 1.3% treasury yield, that means you have negative real rates of around 11%, just under 11%. That's normally a tailwind for gold. But by the way, let me say, negative real rates are the only way for debt saturated governments to get out of debt, because they have only a few choices. They can declare bankruptcy, they can grow their way out of debt, which we've talked about they can't do when debt to GDP is past 100%. So they can declare bankruptcy, default, they can grow their way out, they can tax, or they can devalue their currency, which is as old as the day is long. And that's the trick right now. They're devaluing their currency. They want deeper and deeper negative real rates, which means they want to repress interest rates, but let inflation rip and then not report inflation accurately. It's really a magic trick, and it sounds disingenuous and maybe conspiratorial, but it's objectively true. So they're going to diminish how they report inflation. They're going to want inflation to rip. They want real negative rates of negative 15%. We've done it before after World War II. That's the fastest way to kind of address some of the debt problems, because taxing is not political, defaulting is not politically correct, and growth is not possible. So this is where we are. High inflation, repressed interest rates. And that is exactly what happened in all the great empires that fell in the past. This time we're the world reserve currency, and we got this big bad virus that we have to fight. That's how we're going to justify it. And so it's really brilliant. It's really disingenuous. It's really destructive. And of course, gold shines brightest when you have negative real rates and high inflation. So why isn't gold ripping right now? And that is the $1 trillion question. I think one of the reasons is people truly believe that inflation is transitory, as the Fed will tell you. The Fed also told you that the 1971 decoupling of gold was transitory. Even Nixon said this was temporary. Bernanke said QE1 was just a temporary emergency measure. The history of the Fed or the White House telling you something was temporary when in fact it was desperate is long and distinguished. This is no different. They are going, because they have no choice, to have negative real rates, which should be good for gold. Right now, I think Ronnie Sturflis said it better than anyone. Right now, I think the reason gold isn't ripping to all-time highs is because the market wants to believe or chooses to believe that this inflation is only temporary. And, that is, I think, lazy thinking, but it's understandable in the sense that the deflationists, and there are some very smart people who are pro-deflation, because they say all things being equal, when you have a recession, when you have high debt to GDP, when you have slow economic growth or negative economic growth, well, that's inherently deflationary. And they're absolutely correct. What they're missing is all things aren't equal, because what they're missing is the elephant in the room, which is extreme fiscal and monetary policy, massive monetary expansion. M2 went up 25% last year. By the way, gold went up 25% with M2, net, straight up. And so you can't talk about deflation in an academic, keep my diploma way anymore, because deflation doesn't work the way it used to in the old days when you have monetary policy and fiscal policy off the charts. So all the old things we learned in school don't matter anymore, because central banks and monetary policy and fiscal policy is literally unprecedented at these levels. And so if the markets want to believe deflation is coming and that inflation is temporary, gold will still be stunted. Once inflation becomes obvious, whether it again is the price of that plastic tarp or the toll booth on the GW Bridge in New York, and people realize they simply can't afford things without help from the government, they're going to trust it less. They're going to feel that inflation. And so, that's when I think gold will really take off. But please don't forget, and I'm saying this not without a tinfoil hat, is there will always be manipulation of the gold price as long as these bullion banks and central banks are in control. It's, as they say, don't fight the Fed. And yet at the same time, every duplicitous, broken over-indebted monetary system does eventually collapse under its own weight. Once that faith is lost, gold takes off. In the meantime, gold will certainly do well, but it won't do nearly as well as it should if things were left to natural market forces. And God forbid if we actually had capitalism again, which I haven't seen in so long. Long answer. Sorry, Tom. Long answer, but
not a problem. You covered about 6 of my other questions in there. Comparing inflation versus deflation. Why you don't think that maybe we're going to see deflation? And you lay out a very compelling case for all of it. So, Matt, what does all this mean for gold at this point? Like, are we in the proverbial calm before the storm, or maybe the eye of the storm?
Yeah, look, it's absolutely the question we ask ourselves all the time. And as Ronnie said, and as Egon, my partner, said, Ronnie's one of our advisors, the truth is we don't really know. I think it's honest to say I'm surprised because we have rates that are negative this year, just as they were last August when gold hit 2070. The truth is the environment has never been better for gold, as inflation expectations, I think, are realistic, as GDP is tanking, as the cost of living is clearly going up, despite the transitory be calm, carry on lie from the Fed. I think, again, Ronnie Sturfula hit it best. I just don't think the market is wanting to believe the reality, just like we all don't want to believe certain realities when they're too hard to face. I think it's too hard to face the thought of rising, maybe not even hyperinflation, but significant inflation. It's painful. So I think when the transitory meme of inflation disappears and real inflation is just obvious, gold will go much higher. I think right now the reason is people just don't want to believe it. And I think also, again, not to sound like we're just blaming this as gold apologists, I think there is still significant manipulation in the paper price of gold. I mean, we look at the physical movement every day in gold because we deal only in physical gold for ultra high net worth institutions and individuals, big ticket clients. And we look at the movement from the refineries to the vaults. We look at real gold, not hypothecated paper, levered, forward contracted OTC, nonsensical gold price. And so the supply and demand we're seeing is a heck of a lot more demand than there is supply. So if that were priced accurately, we'd see much higher prices in gold. But eventually, I think the truth always surfaces like a cork. And eventually, the true price discovery happens. But there's a lot, we're fighting the Fed, we're fighting powerful forces, we're fighting manipulation in the futures market and forward contracts. But again, and that's not to be an apologist. I still think gold is definitely holding its own for now. It's just not being fairly priced. The other thing is, the price of gold is important. I understand that, certainly for people that are speculators in gold or investing in the short term. But most of our clients, in fact, all of our clients, understand gold not as a price issue. It's not waning or rising based on sentiment. They look at gold for the reason I do, is it's insurance for currencies that are already on fire. It's like, like a credit default swap, in a sense for stocks or assets that are going to already drown. And I think what they look at gold as basically currency insurance. And it's the inherent purchasing power of your dollar, regardless, or your yen or your euro or your peso, regardless of your price on your dollar denominated price or your euro denominated price or your Swiss franc denominated price or your Swedish krona denominated price, regardless of the price of gold. Anyone who owns physical gold and not ETF gold, and certainly not gold held in a bank, anyone who holds actual physical gold knows that can be converted into a currency at any time. And as currencies go down, the value, the purchasing power of their gold has significantly more power than the purchasing power of their currency. So for us, certainly price is important. We're not going to apologize and ignore that question, because it does matter. It psychologically matters. But deep down, the real issue is not gold's price in the paper market, but gold's value relative to your currency in terms of inherent purchasing power. And that is simply undeniably stronger. And it's not a barbarous relic. It's not something that just sits in the ground and stares at you and you pay a fee for. It's a scarce asset. It's a very scarce asset. And regardless of what central bank digital currency or other fiat or cryptocurrency comes into play, and again, we're not here to poo-poo Bitcoin. I wish I'd bought more of it. The point is, gold as a store of value will be a better hedge against the destruction of your purchasing power and the inherent purchasing power of your currency. And that's where gold has its real, undeniable, historically unmatched value. And so price matters, but purchasing power matters even more. And regardless of the price of gold, the purchasing power of your currency, and I'm not saying this because I'm a Swiss gold person, I'm saying this because it's just an objective fact. The purchasing power of your currency is dying by the second. And as inflation comes, that's just an extra tax on regular people. I find it immoral, frankly, the way policymakers have taken no accountability for their policies. I find it immoral that Jay Powell can say the Fed has nothing to do with social issues, although now he's talking about climate change and labor inequality. That's rich. I mean, that's real rich when you've just spent that office has spent the last 20 years in particular creating the biggest wealth disparity in history, because that wealth has gone into inflated risk assets. And the Fed has always been in the back pocket of Wall Street, not Main Street. And so today they're using things like climate change or worried about labor force inequality because they just want to have an excuse to be dovish. They want to be more dovish. They want to print more money. They want the optics of COVID or labor or climate to make them look good, so they don't look as nefarious as they really are. Intentionally or just stupidly, they've mismanaged this system for decades. And again, I think patient zero for this is Greenspan, really, because he brought the punch bowl to the party in ways that nobody else has. And I've seen him in interviews trying to compare himself to Volcker. And I'm sure Volcker is rolling in his grave, because even Volcker unofficially, Greenspan is no Volcker. And truthfully, no Fed chairman now could raise rates with 28 trillion in debt. They couldn't do what Volcker did. They couldn't, because unlike the 70s, we have 28 trillion in debt, when in the 70s we had less than a few hundred billion. So it's a totally different world.
So Matt, what's your opinion on silver? Could we see it outperform gold just simply due to its speculative nature and the let's say the supply demand mismatch?
Yeah, I mean, the gold silver ratio is making all kinds of interesting moves. Silver, to some extent, less than gold, is being kind of, I hate to say again, as an apologist, manipulated by the markets. Certainly manipulated, but not nearly as much as gold. When gold takes off, silver will move faster. But silver is kind of like, again, I'm stealing from Ronnie Sturfler, who was comparing Bitcoin to gold. I think it's the same thing you could say to silver to gold. Ronnie was saying they're both alternative values, right? They're both considered alternative currencies. And I respect Bitcoin's middle finger to fiat currencies. I expect the intellectual argument behind Bitcoin. And I respect their lack of faith in US dollar or the euro or whatever, because of what central banks have done to it. But digital currencies, and to some extent silver, are like he described it as the Ducati. A Ducati is not a Volvo SUV. A Volvo SUV has 6 airbags. It can get you from A to B just like a Ducati can. A Volvo is a little more comfortable. It's not as sexy. It's not as fun. It's safer in the rain and the snow and the mud. But the Ducati is a lot more fun, but it's also a little more dangerous in the rain and the snow and the mud. And the risk of an accident in a Ducati is higher than the risk of an accident in a Volvo. And I think it really depends on investor profiles, because for some, they can afford to take the risk of riding that Ducati. They've got, the experience, or they're willing to take a scrape. For others, they don't have that risk. I think silver, again, not totally like Bitcoin, but silver will move faster in certain negative real rates. And when faith in fiat currencies die and gold rips, silver will rip real fast. But when there's a headwind or political event or a black swan or some type of optics, which has an impact on precious metals, silver can fall much faster. So I think silver investors have to have a stronger stomach. I definitely see silver at much higher prices than today, just like I do with gold. But when people ask me when, I don't have an answer, because truthfully, this year I would have thought gold would be much higher. I have to admit, it's, other than Ronnie's answer about, I think the market just hasn't priced in long-term inflation. They think it's still transitory, or they want to think that. But when gold rips, silver will rip too. And if for a patient investor, especially an investor who looks at these precious metals as true stores of value, as insurance against the purchasing power, silver and gold are going to favor them over the long term. I mean, Ronnie's right. I think based on just money supply, the broad money supply growth, you can see gold easily at 4,000 to 5,000 by the end of this decade. That sounds maybe not sexy enough for people used to huge moves in Bitcoin. But again, for the type of profile, the type of investor who prefers the Volvo, I think gold is certainly the choice, certainly our choice, and most of our investors choose it. There's always an allocation to silver because it does have that Ducati feel, and it can rise much faster. But yes, to answer your question, silver, like gold, will rise. Silver will probably rise much faster when the conditions are ripe, when the faith in the system and faith in inflation being transitory ends.
Excellent, Matt. Well, I want to thank you for a very great, or wide-ranging conversation here today. Yeah, is there anything else you'd like to add before we wrap up here?
No, I mean, you've asked so many questions. I'm sorry I had to answer them all under one long monologue, but I hope it breaks down okay for your listeners. But there's a lot going on. There really is. I think the key thing for everyone to think about is just understand the debt. Look at what debt does. Look what that forces sovereigns with their back against the wall to do. When their back's against the debt wall, throughout history, they do the same thing. They debase their currency and they inflate away their debt. And that ultimately ends disastrously. And in the near term, it's really hard on the middle class. And the middle class, by every metric, is dying today on the vine. And I think it's tragic because it's a tax. And that's what they're doing. I really don't think this inflation is transitory. And I don't think a new Bretton Woods or an IMF reset is going to solve it, although the optics may be good for a while. I think we're simply at a point in history where the debt is way too high above our productivity, and there's no mathematical way to grow our way out of it. So we're going to have some austerity. And no matter how much the politicians try to outlaw that or excuse it or blame it on a virus, it's going to hit people's lives in ways. And I think, again, the social unrest, the financial unrest are all linked together. And it's going to be a difficult time. It's not doom and gloom. It's just, it's economics 101. It's been postponed for the last 15 years. Yeah.
Some excellent points that you've brought up today, Matt.
All right.
Of course, there's for anyone that wants to read more of your articles, they're available on goldswitzerland.com. Anywhere else you'd like to point to?
No, I mean, if you're interested in precious metals, that's where most of my thoughts are on the gold movement. And Egon writes a great deal about this as well. And he is, in my opinion, one of the leading figures in gold. He's got infinite more experience than me in this market, but we have very similar, almost too similar views on things. So, but yeah, both of us can be found at goldswitzerland.com.
Well, we've had Egon on several times and Ronnie as well. And now we can add your great,
good company.
Yeah, exactly. Yeah. Excellent, Matt. Thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.